Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
Hello and welcome to Flight 133. I'm your host, Charlie Mattingly. I'm especially excited today to introduce our guest and new member of the Leading Edge Financial Planning team, Jonathan Groover. Jonathan, thanks for joining us today.
Absolutely. Great to be here. I've listened to you guys and just excited to be a part of it.
Right on, man. We're excited for you to share your knowledge with us today. I'll introduce that topic in a minute. But first, I just want to tell people that we are grateful for you being part of our tribe, part of our audience. We'd love for you to rate, review, and share this podcast so we can reach other folks as well. And just kind of reach more people there. Again, you know, when people rate and review, Jonathan, it helps the algorithm, it helps the word get out. And so we're trying to, you know, as we say, our mission, Jonathan, every time is to deliver actionable ideas, simplify the complex and cut through financial noise in order to help you build a better mindset for financial and life success. Today, I think Jonathan's going to be one of those where we're going to work really hard to cut through financial noise, talk about complexity in finance, when it's appropriate, when it's not. And in fact, that leads me into today, you know, we're going to go through what we call 7 sophisticated sounding money moves. I don't know if that'll be the title, Jonathan, but we'll figure that out later. But we're going to talk about 7 things when they help, when they hurt, maybe when they're a good idea. And we're going to frame this, either it's a tool that you can use to help benefit yourself, your financial situation. It's a toy that you might, you know, again, hey, let's buy some, let's speculate on individual stock, i.e. SpaceX or whatever. Or maybe it's a trap, Jonathan. Maybe it's, and as you and I often alternatively said, maybe it's trash. You know, maybe we stay away from it. And so we'll try to bring some objective ideas and some as unbiased information as we possibly can as it comes to some of these things. But Jonathan, man, I'm glad to have you here. And I'm glad that you're now part of the Leading Edge team, joining us from South Georgia, a Georgia Bulldogs fan, which is really kind of hard for me to take sometimes, but at least it's a really good football team. Jonathan, give us a personal fun fact, man, that most people may not know about you.
Yeah, sure. I'm from South Georgia. Fun fact I think it'd be appropriate for this being a pilot podcast is the first time I ever flew on a plane was when I decided right out of college to move to Thailand for 2 years to teach English over there. That was my first time ever on a plane. And that was a long flight.
Thailand. Woo, man, you go big, you go early, huh?
Yep. Go big or go home.
Yep. I love it. How'd you like Thailand?
It was wonderful. Yeah, I loved it. Love to go back at some point. Beautiful people. They're called the Land of Smiles. It's just a friendly culture. So.
I got to go to Thailand as well. In fact, I went right before, I think it was 2000, right before the major tsunami that was over there, Jonathan. Remember that?
Wow. Yeah, I do.
And so I went to a lot of the places that were devastated by that tsunami, but you talk about some very friendly, sweet people, just very, the culture there is just, man, it's very cool. Very beautiful people, beautiful place. We got to go some of the I forget what you call it, the Buddhist temples or what, all the things, which was fascinating. So yeah, you don't mess around, man. You go right for it when you get on a plane, huh?
That's right.
Awesome, Jonathan. Well, appreciate that, man. We're glad to have you and excited to talk today. So now let's transition to the meat of the mission today that you and I are excited to talk about, because often, Jonathan, there's, we as consumers are pitched ideas, whether that be YouTube, TV, commercials, social media, and some of them sound really, really good. And so today, you and I are going to talk to about 7 of those, if we can get through them and time permits. We're going to talk to some that we get pitched a lot, some that we've pitched before, Jonathan. And so we're going to try to fight through the noise to talk about when these are appropriate, when they help, and when they hurt. And so, Jonathan, I'm excited to get in this because to me, it's tough to be a consumer today and fight through all the stuff that's out there, man. And so any initial thoughts, Jonathan, before we jump in?
Yeah, there's all you got to do is go on TikTok or X or anywhere, and you're getting fed lots of ideas. Many of them are not good.
Mm-hmm.
So yeah, there's a couple of rules that I think are important for investing in general that I think I want to use at least to guide our conversation. And one of them is there's just no free lunch in investing, and so I'll come back to this a few times, but in any investment, you're going to give up something to get something, and that's important. And sometimes that'll decide if it's worth it or not. Is it worth giving up something in order to get whatever's promised? And I think the second rule, this will be the first one, is if it sounds too good to be true, it probably is. And I think Charlie, I think you're in agreement. We're largely just believe in good old fashioned, boring investing does the trick in the long run. So.
Yeah. Yeah, Jonathan, we're often accused of being the old boring guys or party poopers or Debbie Downer, whatever it might be. But you're right, man. Getting wealthy is it hasn't changed over the years. The economy hasn't, the basics of the economy, I should say.
Right.
Like you said, there's always trade-offs in any economic decision. We'll talk to those. And Jonathan, sometimes what's left out of some of these techniques or products that we will present today, sometimes what's left out in the sales pitch is what's the alternative. In fact, we've discussed before, you and I have discussed before on how we as human beings make decisions. There's a book, Chip and Dan Heath, called Decisive. And it talked about even high-level executives, and they compared them to making decisions like teenagers do. And sometimes we do. And so basically, they had an example in the book. They said, it's a married couple, and they're just debating whether to get carpet in their house or not. So the decision was, do we do carpet or not? It's like this black and white yes, no question. Well, in reality, they said, well, what about, a dozen other types of floors that you might be able to consider? And that's often what happens in the world of finance is, do we do this strategy or not? And again, the salesperson is very aware sometimes that, hey, there's some other strategies that might be just as good, but I'm really not going to talk about those and because I want to focus on this yes or no type scenario. So that's what we'll talk to a little bit, our decision making, and when these might be helpful and when they may not be. And so, Jonathan, one of the things we've learned is that with high achieving folks like our audience, the pilot tribe that we serve, we oftentimes look for complexity. It's a human bias that we have. We think sometimes that the more complex something is, the more effective it might be. And that's just not true at all. Again, it doesn't mean that something complex is bad. It doesn't mean that something simple is bad or good. But just because it's complex doesn't mean it's good. And sometimes that complexity is used as a weapon to make it sound wonderful. And we'll talk to a couple of those examples. The other weapon, I think, Jonathan, that's out there is, hey, this is what the rich people do. This is what, if you're uber wealthy, this is what they're doing. So this should work for you. And that's absolutely not true as well. And sometimes, quite frankly, the uber wealthy people do things that, quite frankly, don't make that much sense either. But it's okay. It doesn't, if they lose $1 million or $2 million, then so what, right? So that's definitely not the case with me and you, at least, Jonathan. So
that's correct.
but anyway, so let's jump in, Jonathan, before I keep blabbing on. Number one, we'll start with the number one. I don't even know if this is sophisticated sounding. To me, it's not. But nonetheless, you told me a great story about some folks that you ran across that were investing in, I guess that's the right way to say it, the Iraqi dinari and the Vietnamese dong. So it kind of sounds comical at first, but it's really not funny if you end up losing your family fortune, right? Jonathan, what do you think on that one?
Yeah, no, I wanted to talk about this one mainly because I'd never heard of it before. And then last year at my prior firm, I ran into two individuals that were doing this. And so I had to kind of educate myself. Yeah, I would say to our pilot audience, this is probably more of a public service announcement. It's not something you're going to see that this is where we're going to go ahead and put this in the category of not just trap, but this is trash. This is basically a scam. So we're just putting it out there to you guys you may have friends or family that come to you about it. And so we're going to talk about it real briefly. But so, apparently, even back as far as 2011, there's these online groups, there's YouTube videos, and they talk about the idea that you can invest in some of these currencies that are essentially worthless. And there's going to be this great, at some point in the near future, and it's always the near future, there's going to be what's called a global revaluation of currencies. And so I'm going to throw out some numbers to your audience. We're going to use the Vietnamese dong as an example. So today, I looked it up today, right now, it takes 26,225 Vietnamese dong to equal $1 US, right? So just rounding down, 26,000 dong per US dollar, okay? It's just been a devalued currency. It's Vietnam has done that intentionally to a large degree, okay? But you can go online and you can go to a foreign exchange currency or like an on coin, purchasing coins. And today, I looked it up, you could buy 1 million Vietnamese dong for $106, okay? Now, let's jump that up a little bit more because that'll make sense for our point in our story. But let's say you want to buy 100 million Vietnamese dong. Well, you could do so. It would cost you $10,600, and you can get 100 million Vietnamese dong. Okay. So I share a brief story. Last year, I had a bank, one of my bank colleagues referred a person to me. And so they set up an introduction. This person called. And they said to me, Jonathan, I'm about to come into a lot of money, and I'm interviewing financial advisors because I want to make sure that you can handle this. Of course, I was interested. I'd love the opportunity to potentially work with you. And so they began to ask me, and they'd done their homework. They asked me all these wonderful questions. Are you a fiduciary? What is your investment? What is your investment philosophy? And then it got more complicated. Are you able to handle, do you have familiarity with trusts? We're going to need to set those up. I said, well, yeah, and we have a team that can help with that. And then they even went further. They said, well, do you guys have a family office? And so I'm thinking, my goodness, we're talking about a ton of money.
Yeah.
Now, I didn't want to dive into where it came from, but at some point when you're talking to a person, you kind of got to get a sense of what it is. And so I said, well, can you tell me a little bit about what's happening here? And she said, I'm not comfortable talking about it right now. I don't want to talk about that. At that point, my spidey senses are up a little bit, but there could be some legitimate things. It could have been a lottery. They want to stay under the radar. It could have been inheriting a large fortune, and they don't want to, for privacy reasons, don't want to go into that. But over time, I finally was able to get her to, I kind of reached a point where I said, well, I can't really help you anymore unless I know more. And so she then disclosed, it's going to sound crazy, but we are investing in the Iraqi dinar and the Vietnamese dong. And what's going to happen is that there's going to be this global reset of currencies. And we'll use the dong as an example. When this revaluation happens, the Vietnamese dong one dong is going to be worth $1 US. Now think about that. Those numbers I just gave, you could go on and buy 100 million dong for $10,000. And if this revaluation happened, you would have your 100 million dong would now be worth $100 million. And they're deeply embedded in these online communities, and they tell them, how to prep banks and all these kinds of things. But the point is that can't happen. That's wealth emerging out of thin air. The mechanics simply do not work. And I think for our audience here, they probably understand that. But the point is, those kinds of things are out there in the world. And you get onto these YouTube channels, you get into these Discord communities, and you buy in and you become a believer, and you start calling financial advisors and figuring out, when this happens, what are we going to do? And I ultimately said, I wish you the best of luck. And if there's any way I can help you, I'll be glad to do so. But she really believed that she was about to inherit or be worth a ton of money from this investment scam, essentially.
Wow.
And thankfully, she didn't pour a ton of money into it. But when I did a little research on it, you could get on Reddit, and there were people talking about their mothers putting their entire retirement savings in this investment strategy. And so it is, I think it's worth talking about because there are these kinds of things out there, and they're dangerous, quite frankly.
Yeah, Jonathan, you nailed it, man. And I think this is like a microcosm for just the things that I'll use your words just because it's accurate. The scams that are out there online that can slowly draw us into this hope of creating wealth out of nothing just doesn't happen. But man, it's so convincing when we get online. And I mentioned in our intro that, hey, we want to, if you rate and review the podcast, it helps the algorithm, et cetera, kind of say that tongue in cheek. But there is an algorithm. And when you look at something online, it's going to feed you more of what you think you want to see. It's going to feed you more of what you think that you believe. It's going to reinforce those beliefs and lead you down this path. And, some people call that the echo chamber that you live in online. And it's a little bit scary, Jonathan. I mean, I think, I kind of chuckled at this a little bit when you brought it up. I was like, this is kind of silly. My second grade maturity level kind of laughed at the names and all that stuff. But nonetheless, it's kind of sad when you see people get, especially maybe our elderly folks that maybe are more susceptible. But I think, again, lesson learned here, microcosm for just be careful the source of information, understand how YouTube works with its algorithms, what you're going to be fed, whether you realize it or not. That stuff's going to show up on your Facebook feed, your Instagram. Next thing you know, you got your Google feeds, showing you the same things. And people are like, oh, this is clearly a legitimate thing. It's everywhere. And in fact, it's not everywhere.
That's right.
So thanks for bringing that up, Jonathan. I mean, that's incredible. Like I said, kind of sounds silly at first, but man. So let's move on to the second one that we'll talk to. And this is one, Jonathan, that I hear from other folks every once in a while. Mainly, this is one that I think our folks at what we call the big wirehouses might sell. I'm not going to name those because I don't want to sound like somebody trashing another business, but they sell a lot of things called structured notes. Mm-hmm. And structured notes, man, they sound so good. In fact, I when I was looking at these, Jonathan, the title of the article that I went to on Morningstar.com, which I think is a good source of objective information, the title of the article was this: a 13% yield. What could go wrong? And then it says there's not much to like when it comes to structured notes. And that article's, we'll have linked to that in our show notes. It's by Amy Arnott, CFA, Chartered Financial Analyst, which is pretty robust designation there. So she knows what she's talking about. But, it's interesting to say, hey, I knew a guy that worked at one of these places, and he's like, yeah, our investments are yielding 13% now. And I was like, what are you talking about? What does that even mean? Because and the reason why that confused me is because, first of all, the prevailing interest rate's 4% or whatever. You're not going to magically go out and get 13% somewhere unless there's, like you said earlier, there's some serious underlying risk. And oh, by the way, you can yield 13% on an investment that's losing tremendous value. You know what I mean? So that's the gotcha there. But Jonathan, just to try to frame this a little bit more, what the heck is a structured note? Structured notes are basically a stock bond hybrid with a limited lifespan, or what we call maturity. When some of these advisors tout them, they sound appealing because they often combine high interest rates with some level of principal protection, downside protection. If the sales pitch goes, if the market goes down, then you're safe. You don't go down with it. That would enable buyers to get their original investment back. If interest rates are at rock bottom, their yields are especially attractive. Again, if you've got going interest rates of 2-3% and you're talking about a 13% yield, boy, that sounds wonderful. So, Jonathan, have you heard of these? Any experience with these before, the structured notes?
Yeah, yes. I came from a bank channel, and so those were part of our offerings. I think, let's go back to what do you have to give up to get something? That's historically the S&P 500 has done around 10% or so. Yeah. So, and also, is it too good to be true? What do you have? Are you giving up to get this 13%, or what's in it that achieves the 13%, or what's the catch? I think is worth noting. And so, yeah, I'm familiar with them. Where would you put them in your? Is it a tool, a trap, toy?
Yeah.
I mean, where would you put it, Charlie?
To me, anytime I think about risk, you can't magically delink risk and return and say, hey, there's no risk. and you get a greater return. I mean, that's just, again, we're just kind of pretending there's a whole nother economy now when we say stuff like that. So there's always the trade-offs that you talked about. I personally would not dip my toes into this water, even as a toy, because if I'm going to take any kind of risk, first of all, I want to understand, like you said, what the trade-offs are. I've reviewed these things, Jonathan. I still don't know what's inside of them. I still don't understand fully, the structured notes and the fees. I learned from my article, they can average about 2.9%. It said an embedded fee was as high as 2.9% in some of these things. And so I think some of these products, these structured notes, are sold under the idea that, hey, this is complexity. This is what wealthy people do, and then when you don't understand it, you kind of feel dumb. Like, I don't want to ask, and I kind of don't understand this. But I think there's a little bit of that helps people sell. It's hard to understand what's going on under there. So Jonathan, to answer your question, I would put these in the trap kind of category, because if I'm gonna first of all keep it simple. Secondly, if I'm going to take risk, I'm going to take equity risk, and then understand that, like you said, there's no free lunch out there. And structured notes, to me, are just too complex, too many moving parts, and they're too expensive to own. The taxes are not a benefit; they're a downside of this type of investment. And so, just a lot of hidden downside there. It was kind of hard to find anything that really was, quite frankly, good about them. Maybe I didn't do a full enough, unbiased, objective search, but boy, it was the information I saw was not great. So I'd put those.
You can see there's a. Oh, I'm sorry. You can see there's a rationale, or there's an incentive to sell them. If the person selling them is getting a 3% commission, that's there may be a strong incentive to sell. Mm-hmm. I think the only thing I'd add is that you said it's a bond equity combo. And I did a little research as well, since we were going to talk about it. And so it operates like a bond. It's supposed to protect your principal, has a maturity, and then pay you interest. But again, if we're getting 13% interest, how are we getting that? Yeah. And they're using derivatives. They're using usually options strategies, which are inherently contain more risk. And there's no guarantee that you're going to get that 13%. I think that's what's probably maybe the main standout for me, is they're pitched at these high yielding vehicles, but the underlying market that they're tracking has to actually achieve something. Otherwise, you're not going to get that 13%. And then I think the third piece, you're always giving up something to get something, is they're not very liquid. Yeah. And so if you want to get out of it, there's just not a real market for these things. And so maybe it's not performing well. Maybe you're in it for a few years and it's not doing what it was supposed to do. And you're like, I want to get out because there's an opportunity cost. Well, they're hard to get out of. Mm-hmm. And so I'd put it maybe as a toy in a rare situation. There might be a use for it, but I just think, do we need to get this complicated for some return they're probably unachievable, and we're taking on needless complexity.
Absolutely. I think the thing you talk about next is probably a better alternative, and that's annuities, which we'll get to in a minute. But Jonathan, one thing that I think about, and if we're learning about a strategy or a product from another person or YouTube or, like you said, TikTok, if that pitch makes you feel smart, rich, and like a special person in the first 5 minutes, then the hair on the back of your neck ought to be standing up, because no investment pitch, no investment strategy should make you feel like you are very special. You know what I mean? That's just not the way it works, right? So you're being sold something when you're making, somebody's trying to make you feel like you are rich and famous. It just doesn't work that way. So Jonathan, that's so far we've talked about the Iraqi dinar, Vietnamese dong, and kind of scams in general. Structured notes. The next thing that we'll talk to, and this is a tough one. I know you could talk on this one for an hour alone, but this is annuities. And I'll just kind of set you up by saying that annuities, the question says, are annuities good or bad? Well, that's a terrible question, because there's there must be 100 different types of annuities. Some of them are good and some of them are not. So that's the difficult part here. You're going to shed some light on this. But the other phenomenon here, Jonathan, is that when I'm talking to somebody, I'll say, hey, look, you might already have 3 or 4 annuities. And therefore, maybe even though an annuity is good, we don't need another one. So for example, when I mean 3 or 4, I mean Social Security is a great annuity. usually a husband and wife each have one. A lot of our pilots have, let's say, a military pension, great annuity, about as good as it gets. And then some of them even have VA disability, another great annuity. If, again, this is highly circumstantial and individual preferences and needs and goals. But Jonathan, help us out on the annuities, section here. A good tool, a toy, or is it a trap?
Yeah, Charlie, I think it's absolutely a tool. You just mentioned several that that are. It's clearly a tool. Fun fact, as I was kind of preparing for this, annuities have been around at least since the Roman Empire. So obviously something that has that much history, there's got to be some use for it. Annuities, what are they? Because you gave three good examples. Annuities in their purest sense are simply taking a chunk of money and then guaranteeing in some way an income stream from that chunk of money. So essentially they create pensions for yourself. And you're right, there's many different kinds of annuities. I think maybe we will do an episode on several different types because they range from the simple to the complex, and they do have many good uses. I think, for sake of time, let's just talk about a few things to consider if you're going to do an annuity. One, to answer your question, if you already have Social Security, if you have another pension, my wife's a teacher, for instance, and so she will have a teacher's pension. How much more do you want to create in just an income stream when there might be better uses for those assets? So annuities are offered by insurance companies. I think that's important to note. And if you end up turning it into an income stream, it's the insurance company that's guaranteeing that lifetime income for you. Okay. And they have different ways of doing that, but you're essentially giving or loaning the insurance company money in exchange for a guaranteed income from them, and they are guaranteeing it. So I think one thing I'd want to say is if you're going to do an annuity, you need to know about the insurance company that's offering it. That's where credit quality comes into play. There are many, many, many annuity companies out there, but you really want to make sure you're working with a very strong, very high quality insurance company. I think another thing to think about is liquidity. And this is, I think, if you get nothing else, if our audience gets nothing else, get this, that if you do an annuity, you are tying that money up for a pretty substantial amount of time. Most of them, for the ones, they range from 3 to 10 years, let's put it that way. But many of them are going to be in the 5 to 6 year range where you've effectively committed that money, tied it up. And if you want to get out of it, if you have something that you want to do with that money otherwise, in the early years in particular, you're going to incur a pretty hefty penalty, usually in the range of 8 to 9%. So again, can be a very useful tool, but just know you've got to commit that money for the long haul. And then again, they're different types. They accomplish different things, and they range from simple to complex. But know what you're using it for. It's for the purpose potentially of creating income, and in a guaranteed income stream. And I put this quote marks up here for our YouTube audience because it's guaranteed by the insurance company, right? So we go back to that. So I can think of one client or client type in particular that an annuity could be useful for. And it's for clients that have a strong need of consistent income and they get spooked by market fluctuations and things like that. I think that would be an appropriate use. I don't recommend putting everything in it because, again, you're tying it all up. But if we could give peace of mind to a particular subset of clients through saying, hey, well, let's take a little bit of money here. We're going to turn it into income for you. No matter what the market does, you're going to get that income on a monthly basis. I think that's a potentially good tool.
Yeah, absolutely. I think you're right. And what we've learned too is we've learned from research, from real life, that if somebody has, like you said, an annuity, whether that be Social Security or they go out and purchase one or an extra one, they have that floor of spending that's disconnected from the stock market. Let's say that part. Mm-hmm. That way they can spend that amount even if the stock market tanks 2008 style. So that's an attractive piece. I remember right after 2008, annuities were kind of all the rage. The insurance companies are wonderful, but sometimes they'll take, the war fought last year and develop a product for it. But nonetheless, but nonetheless, they can be good. And what research has shown is that those folks that have some type of annuity tend to spend a little bit more stress-free in retirement because they know they've got that floor that is, as you said, guaranteed. And by the way, you and I aren't even allowed to say the word guaranteed in any other product except annuities. And just to add a little color there, the guarantee, as you mentioned, is as strong as the insurance carrier. These insurance companies have been around 100 plus years. But what if, Jonathan, what if one of the insurance carriers went out of business? What's there to help somebody?
Yeah, that's a great point. Great point. Most states have what's called a guarantee association. And for life insurance companies, annuities are offered by life insurance companies. In order to do business in that state, they have to be they usually are required to be part of the state guarantee association. And so for instance, I live in Georgia. The state of Georgia has its own guarantee association, and life insurance contracts and annuities included in that are insured by the state of Georgia's guarantee association up to $250,000. So in my prior experience, annuities were sometimes part of my practice. And I had to make it very clear, these are not FDIC insured. You do not have that. But there is some level of protection if an insurance company were to go under distress and things like that. So again, we got to keep in mind, how much money do you want to put into this? How much time do you want to lock it up? I think the question is, what are we, with any investment, what are we trying to accomplish with it? What is its purpose? And then, like you said, are there alternatives out there that might work better? And sometimes there are other things out there, and sometimes annuities are the right choice.
Absolutely.
Or a good choice.
You nailed it, Jonathan. I mean, unfortunately, everything can't be so simple as yes or no. And it's, people's lives are different and complicated sometimes. But I would encourage everybody to listen to Flight 114. We did that last fall. It was called The Science of Happy Retirement with Dr. Michael Finke. And he's a professor at the American College of Financial Planning, highly respected guy, fun interview. But he talked about his studies in retirement for people in retirement and annuities and how they relate. So go check that out. That was pretty interesting as well, his take on those. Jonathan, let's jump into one where I'll tackle really quickly. And we've got a few minutes left here, so we'll tackle the last few in the next few minutes. But one of those that we put on here that we think take some extra thought and intentionality, and that's your own airline stock. And so I know I'm put your steel-toed boots on right now because I'm about to step on your toes. But Jonathan, when I was flying around, we all thought we knew and had, quite frankly, inside information because we were pilots there. And really we don't. And there's been a lot of historical examples where you should kind of consider strongly staying away from your own company's stock. And Jonathan, it's not just airline folks. It's not just us. No. We've got people in other industries. If you're a banker, guess what? You're going to own some extra financial stocks. It's just the way we are as human beings. It's okay. So consider, I think, as far as your own company stock, consider if you want to invest in it, some of the employee stock purchase plans are pretty decent. You get a little discount, maybe some tax advantages, maybe. But consider keeping that to, I don't know, Jonathan, what do you think? 7% or below, maybe 5% or below of your overall net worth. Because, man, what happens in our business, in the airline world, professional aviation world anyway, is when the economy tanks, the airlines go down with it. And the airlines are some of the first to go down with it as far as in a recession of some sort. And they're sometimes the last to recover. So your job might be at risk. You might be flying less. Your company's stock is tanking. So all those things at once are really painful. So I would encourage extreme caution when it comes to your own airline stock investing. Jonathan, what do you think?
No, I can't speak to airline stocks, but I think the point you make remains that it's tempting. Anytime you work for a corporation, you're usually going to have some type of stock purchase program, gives you some discounts. And there can be a real tendency to, I work for this company. I believe in this company. It's a great company. So I'm going to put all of my eggs in the company stock. And of course, there's just so many historical examples of where that can go really wrong. And so it goes back to our philosophy of diversification. Yeah, own a little bit, no problem with that. It gives you some buy-in for your company and some ownership, but don't put so much in there that you've really undiversified yourself.
Yeah.
Yeah. So diversification is the name of the game, no matter
Yeah.
what company you work for.
Yeah, that's the truth. And I'll say,
Yeah.
that's I wouldn't call it a tool, but I would call it maybe more something closer to a toy that you can, use maybe for your as a fourth or fifth kind of option to save, perhaps, maybe. So consider that. Definitely not a trap by any stretch, but just use caution. Jonathan, the next one we have on our list is an exciting one. Leveraged ETFs, man. This sounds really cool. 3 times. I'm about 3 times leverage, Jonathan. So, you're going to correct me because I am wrong. I'll just throw this out there, man. If the S&P goes up 10%, I get 30. What could be better than that?
Yeah, so leveraged ETFs have come on the scene in the past, I don't know how many years, but so what is an ETF? It's a fund that usually tracks an index. So there's an S&P 500 ETF. There's actually many of them. And the idea is that instead of trying to buy the individual holdings in the index, you just buy the ETF and you track that index. And so now, because we love octane and we like put our foot to the gas pedal. Well, hey, why buy the S&P 500? I could triple my exposure to the S&P 500, right? What could go wrong?
Yeah, exactly. What could go wrong now?
Yeah. So yeah, I mean, the simplest, it's leverage. I think that's the first thing. So you are you are tripling your risk essentially. Now, if you had a crystal ball, Charlie, and you knew what an index was going to do over the next year, why not? Why not do this? Why not 10x your exposure? But the fact of the matter is we don't know. We don't know what's going to happen. And so just as it could go up and you get triple the gain, it can go down and you can be in a world of hurt real quick. So I'm just generally not a fan of taking on leverage unnecessarily because it increases risk. But there's a second piece of it that I think is important to note. ETFs, they actually reset daily, okay? And so they are meant, and if you go anywhere and read about them, if you try to buy them in your account, you're going to get some type of disclosure that says that these are short-term trading vehicles. They are short-term investments. They are not meant to be long-term investments. And the reason for that is because their value resets daily. And I won't go into all the math, but because it gets complicated, but it's possible that you don't actually get triple the return, even though it's triple level. And so I'll just give you kind of a quick example. So maybe you track an index, the index returns 5% on day one, okay? It loses 4% on day two, so we're down to 1%. And then it jumps 3% on the third day, okay? So that's a 4% return over 3 days. Won't go into all the math, but because it resets daily and it starts over, your return in the leveraged ETF was actually only about 10%. And it's what we call a sequence of returns risk. Yeah. That it just returns, they vary. And so you had a 4% return over 3 days in the index, but you did not have a 12% return in the leveraged ETF, and that's the daily resetting feature of it. And so I think that's another thing to keep in mind is if you're thinking of these as these long-term investments, you're 20 years old and you just want to leverage 3x the S&P 500 for 20 years, it's really not going to work out that way. And so it's something to be mindful of.
Yeah, absolutely. I don't understand these as well as you do, but it sounds like just because the S&P returned 10% in 1 year and I got a triple leverage, I'm not going to get 30% perhaps.
That's very correct. Yeah.
And even so, it's hard for our minds. I think we've been trained, Jonathan, to think more risk, more reward. And in this case, that's not exactly true. And, in fact, I think the math that you're talking to me is amazing because it's if I have $100,000 and I lose 50%, well, then I'm down to $50,000. Well, to get back to even, I need to have a 100% rate of return. So I got to have twice the rate of return up than I had on the way down. Now that math is not linear, but nonetheless, it's pretty extreme when you have some pretty hefty losses, which you could in a triple leverage ETF.
Yeah. Yeah, and Charlie, not only that, just before we end this, there are not just ETFs for indexes anymore. You can buy leveraged stock ETFs where you might could buy Nvidia at 2x leverage. And then you're really just intensifying your risk because now you don't even have a diversified portfolio anymore. You have a single stock that you've doubled your risk right away. So I think these are instruments that you need to be very, very careful of. Yeah. And again, my question to anybody pondering them is what is the purpose? What are you trying to do here? And do you need to be taking on that much risk to accomplish what you're trying to accomplish?
Yeah, Jonathan, we talked about alternatives earlier. And if your alternatives are, I go to Vegas and I gamble on the craps table, then maybe triple F leverage ETFs for a day or two, or that's an alternative. We'll save some money on travel.
Lose your money fast.
You get to gamble, and you don't have to go anywhere. But anyway, so
there you go.
But no, like I said, I think you just got to do your homework, man. It's just you can't not do a lot of research and do something that's as complex as that. So, Jonathan, we've talked about the Iraqi dinar, Vietnamese dong, structured notes, annuities, leveraged ETFs, airline stocks. I'm going to hit on one we call the mega backdoor Roth IRA. Is this the tool? Is this a toy? Is this a trap? And so people that have listened to our podcast already know that we love this one. We think this is an absolute tool. Now, granted, it's not for everybody. It may not work in every situation. In fact, Southwest Airlines is the only one that doesn't have even access to this, what we call mega backdoor Roth, which is actually just after-tax contributions to your 401k. I think every other major airline, I know United, Delta, American, FedEx, UPS, all have this capability. And so it makes sense sometimes. But it is another thing that has its place in the priority. But let me explain what this is first, Jonathan. I mean, it's kind of a fancy name, mega backdoor Roth. All this is if I'm going to use American Airlines for an example. If you go into your 401k at Fidelity and you can adjust the percentage of your 401k contribution, I want to send 12%, whatever it might be. I want that to be pre-tax or Roth. I can make those choices there. And then on down one more lower level, you're going to see your option for your catch-up contribution if you're 50 or over. And then usually, I think it is one more level lower, it'll have an option for after-tax contributions. And so if you are one of those that you save a tremendous amount, you fill up those buckets early in the year, you will have an opportunity to do, after you max out your $24,500, we call that the 402G limit, and that's for 2026. If you max that out, and again, you're under 50, you could do after-tax contributions that could be immediately converted to Roth. Now, the amount you can do, Jonathan, depends on, how fast your airline is putting money into your 401k, because you're still limited by the IRS limit of $72,000 if you're under 50. And I know I may have lost some people there, but the upshot is that may not work for everybody. You got to shove a whole lot of money in the first few years of the month. That's the point. But if you can, boy, it is a really good strategy. Now, let me talk about the priorities really quickly. There's also the backdoor Roth that may be a little bit more easy for you to do. And, you can spread that out over the year. You don't have to put a bunch of money in the first three months of the year. I joked with one of our guys, Jonathan. I said, are you eating cat food now? Because every bit of your money is going into your 401k. It's pretty incredible. But maybe the backdoor Roth is a better alternative to consider first. And maybe even turning your contribution to Roth is a good alternative. In other words, Jonathan, some of our folks I've seen where they're like, hey, I'm going to do this mega backdoor Roth. I'm like, well, you're not even doing Roth 401k or Roth, backdoor Roth. So those are things we need to consider. Let me backtrack a little bit, Jonathan. There may be a time where you do pre-tax 401k and you do mega backdoor Roth. I'm not saying that's not a thing, but I'm saying there is an order of priorities, and just think through those before you jump into it. And so this category, we've written a lot about this as well, Jonathan. They can go to our website, leadingedgeplanning.com, and look at some articles we've written and some YouTube videos we've done on this as well. But we absolutely think this is a great tool. It's just got to make sense for your certain, specific situation. And it can be a great way to get a lot of Roth money into your savings. So that's the beauty of it.
Yeah, and I would say this is a tool. It is complex, and we talked about complex doesn't always equal good, but this is one of those that I think you probably ought to potentially work with somebody or have somebody that's guiding you, because there are tax implications and things like that. But it can be a very powerful tool to, like you said, start getting that money in the Roth, which has a tremendous tax benefit down the road. So it's a helpful tool.
Yep. Check that out. And again, you nailed it, Jonathan. I mean, you want to seek tax advice on this one. You probably want to get some good advice for your specific circumstances, because on this podcast, we can't give specific advice because we're talking to too many people and too many different circumstances. So check it out and contact us if you want to learn more about it as well. And we're happy to help. But Jonathan, the last one we're going to leave for you, and that is... Is long-term care insurance a tool, a toy, or a trap? What are your thoughts?
Yeah, I think a tool. And again, a tool is a tool. It's not the whole tool belt. It's a tool. And different tools have different purposes. I think we're probably running close to time here. So I think the only thing I would say here is that, long-term care, we call it an estate robber. I grew up in my background, it can just long-term care expenses. What is it? 65% of people are going to need long-term care at some point, something like that. So, the costs are outpacing inflation, and so this can really deplete assets. And so, long-term care insurance. I think what's important. I think what I'd like our audience to know is there's been a lot of evolution in the long-term care insurance space, just like there is in many products and solutions. And so there's, it used to be long-term care insurance was sort of like buying term life insurance. It was a use it or lose it kind of scenario. And a lot of people didn't want to do that. They didn't want to buy long-term care insurance because you may not need it. And I think what I would say, and we could talk in a further podcast about this, is there are many different ways to structure long-term care using insurance as a solution. And so again, it's just one of those. We need to understand the situation. We need to understand the purpose, and then we need to find the right tool to accomplish that. So, Charlie, no, I think it can be a fantastic tool. I think probably one thing I'd like to leave our audience with is that I think out here in the financial services and financial solutions landscape, so many products get pitched as a solution to everything or some type of all-encompassing solution. I think annuities fall into that category. And, long-term care insurance it's always good or it's always bad. And it's really not. It's a matter of what's the situation, what's the purpose. And there are solutions that can be helpful, and just how we use it.
Yeah, you nailed it, Jonathan. I mean, we did an entire podcast on this, Flight 107, Making Sense of Long-Term Care Insurance Options with Amy Arnett. Check that out. She did a great job of just explaining what your options are. And by the way, self-insuring is one option. Right. And sometimes that works for people depending on their circumstances. Some people have preferences that might drive this decision, personal preferences versus mathematical objective information. So there's a big personal component there, and there's some options out there. This is a particularly tough one though, because man, it's very expensive. You're not going to insure this cost 100%. You're going to try to mitigate this risk. And again, this is kind of like the annuity, Jonathan, where some of those folks that have long-term care insurance and it's appropriate for them, they don't have to go through retirement thinking like, oh, I can't spend X amount because I might be in a long-term care facility someday. They know that risk is taken care of, so they can spend a little more freely. That's just one example. I'm not pitching it by any stretch because, again, too many different circumstances. But that's one we see where it is kind of nice to at least address that risk. And by the way, Jonathan, no decision is a decision. If you ignore this altogether, well, then, that is a decision as well. So we hope that people take the time to review. And we do believe, like you said, it can be a great tool for peace of mind for not only you, but your family, your heirs, etc. But Jonathan, thanks so much for sharing today on those 7 topics and strategies. Man, that was really good to learn about some of those, especially like the dinar and the dong and the triple leverage. But anyway, so, Jonathan, I'll just finish up by saying I still believe that defense wins championships. Defense is the best offense, actually. And so, most of our pilot families hit financial independence and financial wealth with a few boring habits. No gimmicks are required. Just discipline with their savings, discipline with spending, basic tax planning really will get it done. And so we kind of always preach the boring, Jonathan. But remember, man, if it makes you feel smart, special, and it's extra complex, then you may want to really dig in and reach out to us. We're happy to help at leadingedgeplanning.com. You can email me at charlie@leadingedgeplanning.com. And you can email Jonathan Groover at jgroover, Groover, JGROOVER at leadingedgeplanning.com. So we appreciate you all today. Thanks for, we're grateful for our pilot audience. Thanks for sharing the podcast and rating and review. And Jonathan, we'll see you next time.
Absolutely. Thanks for having me, Charlie.
Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out, give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie@leadingedgeplanning.com. Again, that's Charlie@leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.